We all love a good bargain, but what are those stocks out there that we would buy if we could just get them at the right price? The experts have got plenty of them. There's always stocks we want to own at a lower price. How easy is that? But give us one that you think, today I'd like to own at a lower price and happy to hold for a long time.
Yeah, oh look, I really like Nanosonics. I think that's a great business, very high quality. They have a consumable and capital sales model. As their installed base grows, they grow the pool of annuity revenue that they get through their consumables. Their product is essentially, it's a must-have for the hospitals for infection prevention. There's no real substitutes. They've got a really strong market position and a great brand. You know, the management team are very high quality. They've been guiding the market very well and living up to what they've been telling the market they're going to do. Got no debt, they expense all their R&D. And looking forward, they're growing their product suite. So I think this year, you know, they'll be announcing that new product.
I think in the Australian example, what we really learnt is what can make you a lot of money investing in Australia is finding a company that's got a niche that doesn't seem too big domestically, but they own that niche globally. And there's a number of those in Australia, and they own it, you know, with themselves or one, maybe two others. So I think looking back, and the obvious one that's now second or third biggest company in Australia is CSL. It always looks 10 PE points too expensive. It always seems to deliver. It's got a very good niche in blood products around the world. If I sat down with you and said, well, what's one business we want to get into? Well, fractionating blood and making products out of it. You'd say, well, is that really a market? Well, it's a tremendous global market. They own it with one other player effectively. And I think if you could get it at that 25 to 30 times in a down market, I don't think it's impacted by economic growth. It's not cyclical, and its growth is probably there at that 8, 9, 10% for the next decade.
You probably already know Altium's a software business that designs software for, the software does design for printed circuit boards. It's very unique in the fact that...
And been a terrific performer.
Yeah, it has, and part of the reason for that has been its uniqueness in that the current playbook with tech stocks is to take a bunch of money, burn it, hopefully I'm a bigger business in the future and then I can worry about profitability. Altium's grown revenue and also profitability along the journey. I think that's product leadership that's gotten there. And then you think about what Altium's got going for it looking forward. There's a tailwind in the industry with more electronic connected devices being produced. Potentially do a deal with Dassault Systems, their European partner, and they quite clearly articulate a compelling strategy to move more across the value chain in terms of what they provide and into the hardware space.
Maybe an obvious answer, but Amazon is one that we'd love to own. Such a high quality business, an incredible business. They've got the e-commerce mega trend behind them. They've got the hyperscale cloud through AWS sitting behind them, but ultimately at a very high multiple. They're dealing with extra capital investment in logistics in the US business, huge investment losses in the Indian business and potentially in LATAM as well. So it's just hard to find the value story there.
Woolworths. They're executing the house down. It was our biggest position a year ago in the fund, and we've been slowly reducing it as the market sort of caught on to the food inflation, really rational competitive dynamic. Woolworths execution, they're braining it, but it is on 26 times, so the upside probably isn't where it was before.
IDP would probably be the stock I'd choose. I think in a fairly short period of time, the company's done an amazing job after being spun out of Seek. The management team is excellent. The runway that they've got for growth is extremely impressive, and they've executed really well to date. So there's no reason to think they can't keep achieving. However, it's trading on about 55 times current year earnings, which is the sort of multiple we see for high-tech stocks, SaaS stocks. So too expensive for now for me.
The one that stands out for me is Nanosonics, NAN, the code, great business, run by ex-Cochlear guys, really built up, great 50% penetration in the US market. They've got another product coming at $7. It's just, no matter what you do with your model, you can work hard at it, you just can't, you cannot get there to $7. The analysts on the street have $2 or $3 in the valuation for incremental products they've got coming to market, telling you that everyone's trying to backfill the valuation. Can't quite get there. Would love to buy it at $5. It's a classic example.
You need a stock that's got positive earnings revisions in that the market is underappreciating how good this story is. Chipotle absolutely fits that bill. So Chipotle Mexican Grill, think Guzman and Gomez if you're Australian and you like Mexican food. So that's the business that they've copied. Firmly in an upgrade cycle. I just can't quite get to the multiples. So if I saw it cheaper, that is a great business I would love to own. Very well run, really interesting story, great comps.
Realestate.com. We bought it at $2.50. We sold it at $10. We were high-fiving each other, and then it went to basically $100. So that's been a big mistake. Now it's
The
trading.
early leavers have missed the party, haven't they?
We've missed the big story. So, look, this has now got the housing cycle behind it. It's got pricing leverage. It's a great business with a great market position, trading at 45 times PE with 15% growth, just a little bit pricey for us. However, if they do stumble, we'll be there hopefully to pick it up at a better price.
And what's the stumble mean? $80, 75?
Yeah, well, something that puts it in a price to earnings ratio to growth that's a little bit more attractive than where it is at the moment, certainly.